Hey guys, how's it going? It's only been a couple of weeks, right? Yeah, definitely been out of it for a while. A lot's happened since we last talked. I got married. I went on an amazing honeymoon to Japan. We sold our first flip. We sold our condo, and yeah, now we're under contract to buy another house. Not a project for our real estate business, but a personal property for my wife and I to continue to grow our family and to be in for a while. So welcome to Charge It to the Game EP. I don't remember, but happy to be back. Looking forward to being back more consistent again and sharing everything with you all. So with that said, let's get into it. So today I wanted to use this EP to talk about how I'm investing in 2026 and the things that I'm trying to do to protect my wealth and to make sure we're as there's the word, insulated from all of the financial turmoil that's going on, all of the potential disruption that's happening with AI, with the war, with everything like that. So I wanted to take the time today to talk through our investment strategy for 2026. So first things first, we're buying a house. Yeah, it's considered to be one of the most unaffordable housing markets. Well, not one of the most unaffordable housing market in history. And we're buying a house. Yeah. So why are we buying a house? What price range did we buy in? Those things. Well, first of all, we were looking for some more space. We're looking for a house to kind of grow our family into, as well as my wife's parents. We want to hopefully have them with us in the near future when we're starting to have children, hopefully allow them to come visit and stay with us more often, as well as like hosting family events. And our current home, it's not tiny, but it's one that I was kind of personally ready to move on from. And we're not selling the house, right? This house is going to turn into an income generating property for us. We have an amazing interest rate on the home. We have a 2.75% interest rate, and being able to rent that out and kind of start generating some passive income, and for me, kind of helps me feel a bit more insulated, helps us to like generate more capital to throw towards investments, throw towards debt, things like that. So not only are we, kind of buying in what we think is a reasonable area, we have some specific characteristics for the home we were looking for, and this is why it makes us a little more comfortable buying in today's current market. The first thing we were looking for is we tried to make sure we bought in a neighborhood that's not still under construction. We didn't want to be pricing or competing in terms of appreciation to like the builder, right? If you buy a house in a neighborhood where the builder's still building homes, you're competing against them. And if you need to go to sell in 3 years and even 5 years, sometimes they're still building out the neighborhood. We were looking at homes in an area called the Aurora Highlands, and it's a beautiful area. They're going to make a wonderful community center. It's going to have a lot of infrastructure that's going to get built up over the next few years, but the construction cycle is not supposed to be done until 2030, right? So until then, our house appreciation doesn't really move the same way a house in a neighborhood that's completely built out, it's a mature community, it's not going to appreciate the same way. Not only that, but in those newer neighborhoods, you usually have higher HOAs, usually have higher property taxes. So those are some big things that went into our process of like looking at homes. And usually that means you're buying a bit of an older home. But ultimately, we ended up finding a home that those fixed costs, such as property taxes and the HOA, were not too high, because those are things that are only going to continue to go up. Property taxes at least. We also found a neighborhood that's a bit more mature. The neighborhood's completely built out. It's in an area where new construction is still like maybe 3, 4, 5 miles away. So that gives us the insulation of not competing with a builder if we ever needed to sell in the short term. With that said, we bought the house with the idea we plan to be there for at least 10 years. So the way that money's being printed, the way the government's continuing to kind of debase our currency, we're not concerned about not being able to appreciate. Even if there is some event where housing prices are impacted, I don't see us having an issue with appreciation over 8 to 10 years, right? We're not buying the house to sell it next year. We're not buying the house to sell it in the next 3 years, right? So for us, buying a house now makes sense. So that's one thing that we're doing this year is we're buying another property. We are putting 20% down and we're doing some of those things, and we saved and we're making sure we're able to do those things. So that's why for us, buying a home this year makes sense. Next thing we're doing is we're just continuing to invest as much of our income as we possibly can. I think right now we're saving and investing maybe 20% of our income. And it's not exactly where we want to be. I want to get that number closer to 30%, but it's amazing. And making sure we're taking advantage of our 401k matches, things like that. And our investment strategy is, I would say we're probably putting, of that 20%, 5% of it's going into Bitcoin. Definitely still a long-term believer in Bitcoin. I think, again, with the debasement of not only our currency, but all other currencies, with the battle against the dollar, other countries trying to sell treasuries and get away from the dollar as much as they can, I think our spending power in the U.S. is going to continue to get debased. And the only way to combat that is to buy assets. Assets could be anything. They could be houses, it could be real estate, they could be stocks. For me, I think Bitcoin is the hardest of those assets, but I do like to be diversified. So that's why only 5% is going into Bitcoin. We bought a lot of Bitcoin last year. We bought a lot of Bitcoin in the early 2020s after the crash at that point. So I'm comfortable with the stack that we've built up so far, and I want to continue adding to it. And we're doing it in other ways as well. For example, I have the Coinbase credit card. So when we spend money, we get a little bit back in rewards in Bitcoin. So trying to take little steps to continue to add to our Bitcoin stack, because I truly believe in the long term, it's going to do some pretty amazing things. I do think Bitcoin eventually is going to be $1 million a coin. When that is, I don't know, 10 years, 8 years, 5 years, who knows? But I don't bet on the timing of it. I just believe it will happen, and so I invest accordingly. The other 15% of our portfolio goes into broad market index funds. My wife and I do have 2 separate portfolios at the moment. Her portfolio is very much more conservative, much more like index fund focused, more stable investments, I'd say. And my portfolio has a lot of index funds, but it's probably only 20% index funds, and the other 80% is individual stocks. I would say I have more of the risk on portfolio, and her portfolio is more risk off. But again, it's a very balanced way, and this is our taxable brokerage. It's a balanced way for us to kind of be aggressive in the market while also kind of steadily growing our net worth. And then as far as like my 401k, I'm contributing 8%. Again, could be higher, but my company only matches 6%. So you should always just invest at least the company match, because that's 100% right there, 100% return immediately by getting your company match. I did bump that up to 2% this year, or up 2% more to 8%. I started to move it up to 10%, but I like investing that extra capital into Bitcoin versus just into the market. Just personally, again, I see more long-term growth and just more long-term value capture in Bitcoin. So that's where I'm putting that extra percentage. In my 401k, though, it's very much more of a conservative portfolio. It's maybe, I'll probably put an image up here. I think I'm 50% or 40% something. I think I'm 60% in the S&P 500. I think I'm 30% into international indexes, which I think are going to do great over the next couple of years. I think the international markets are somewhere to put some capital as the US market maybe stagnates, and we have all of this money trying to funnel into all of these IPOs for Anthropic, OpenAI, things like that. I think that's going to take some value out of the indexes. The S&P 500 may be a little bit lower or slower of a return, and I think international markets are a great place to kind of capture some of that return over the next couple of years. So I think it's 60% S&P 500, 30% international index, and then I think 10% is in like emerging markets. So it's also international, but kind of early stage companies, lower market cap companies, things like that. So we're buying the house. We're continuing to invest 20% of our income. And then the next thing we're doing is we're trying to grow our skills. We're trying to really lean into the newest technology. I'm trying to play with AI. I've built applications, I've built workflows, I've built websites, I've built agents. I'm trying to get some AI certifications. If you didn't know, I work in cybersecurity, and I've worked in technology and IT my whole career. Well, I'm trying to make sure that the new workplace, the new workforce, all of the AI level, AI kind of focused positions, there's a position and a role for me, and trying to make sure that I don't get, I would say, skilled out of the workforce. Same thing with my wife. She's a realtor now. She's trying to work into those skills. She's working with more experienced realtors. She's going to trainings, conferences, things like that, to be in the room. And that's what I would suggest for you if you're trying to do the same this year and not be left behind. Just try to be in the room, be around the people that are doing the things, ask questions, play around with things, test them out, because if you don't, you get left behind. And that's one thing we're trying to do is, in my opinion, that's an investment. We're investing in ourselves, and we're investing in our future. We're investing in our growth, and trying to make sure that if and when these layoffs continue to happen, if I'm caught up in one or whatever, that we have skills to fall back on, we have businesses to fall back on, we have assets to fall back on. And the last thing that I haven't mentioned yet is we are trying to build up a bit of a cash position in the form of a emergency fund. Ideally, it should be 6 months, but we're probably going to shoot for maybe 8 months to 12 months of an emergency fund. Again, just in case layoffs are continuing to happen. We've seen, thousands of layoffs at Oracle, at Amazon, Microsoft, Disney, you name Fortune 500 company. They're laying off staff, and they're trying to augment it with AI. Whether that's the case or not, that's what they're saying. And, just trying to make sure that I'm a employee that, one, it's hard for my company to lay me off, but two, if I do get laid off, I have the skills and capability to immediately find a job or find a job quicker. And then three, being able to have other income, businesses, and like safety nets such as emergency funds to hold us over while that's happening. So I think that's everything, right? That's our investment thesis. That's what we're doing in 2026, right? We're buying a house. We're turning our current home into a rental. We're continuing to save and invest 20% of our income. And lastly, we're investing in ourselves. We're learning skills. We're staying ahead of the latest technology. And it's interesting for me because it's kind of technology and like sometimes even social media is kind of a bubble, right? If you watch personal finance videos, if you stay on top of investments, and if you stay on top of emerging technology and the latest technology, sometimes it feels like you're behind because all you see is all the things people are doing, all the cool things people are building, or all the growth of people's investment accounts, and you're like, man, I'm so much further behind than that. But if you zoom out and you kind of look at the rest of America, you're doing fine. The average American has a hard time coming up with $1,000 for an emergency. If an emergency comes up, they have to use credit. Most of Americans are in deep credit card debt. Most Americans can't buy a home. So when you zoom out, you realize, wow, you are doing pretty good. I feel like we're doing amazing. And I just want to kind of help and share as much of what we're doing to hopefully help you be able to do the same and do some amazing things yourself. So with that said, thanks for watching the channel. I am Morgan Hassan. I will be more consistent. I will be back. Charge it to the game. May continue to be back. If not, I'm just going to be back more, making some more videos, more content. So please like, comment, and subscribe. I appreciate you sticking around for these months that I haven't posted. But we'll be posting a lot more. We're looking to get some more flips done this year, so we'll definitely be sharing a lot of that content. My wife has started her content journey for her real estate career. She's now a realtor, so she can buy and sell all of our projects. I'll put her Instagram right here. And yeah, thanks for tuning in. I hope you guys continue to get at it. And I'll talk to you soon. Peace.